What if I told you that $50 a month, less than $2 a day, invested starting at age 22, can turn into over $200,000 by the time you retire? Not because you picked the right stock, not because you got lucky with crypto, just because you started early and let time do the work. Most people hear this and think it sounds too simple to be real, so they wait. They tell themselves they'll start investing once they have more money, once the debt is paid off, once things settle down. And that waiting is the most expensive financial mistake you can make in your 20s. In this video, I'm going to show you exactly what $50 a month actually grows into, where to put it, and how to open your first investment account today. Even if you have no idea what you're doing and you've never bought a single stock in your life, let me show you the math that changes how most people think about investing. Two people, same goal, different starting points. Person A starts investing $50 a month at age 22. They never increase their contributions. They never pick individual stocks. They just put $50 a month into a boring index fund and leave it alone. By age 65, assuming a 7% average annual return, which is the historical average of the stock market after inflation, they have just over $200,000. Person B waits until age 32 to start, but they invest $150 a month, 3 times as much, to try to catch up. By 65, they have just over $185,000. Person A invested a total of $25,800 over their lifetime. Person B invested $59,400. Person B put in more than twice as much money and still ended up with less. That gap, that $200,000 versus $185,000 outcome from wildly different inputs, is compound interest. It is the single most powerful force in personal finance, and it works almost entirely in your favor when you start young. The one resource you have at 22 that you will never have more of is time. Every year you wait to start investing, you are permanently reducing the ceiling on what your money can become. Before we talk about where to put your money, there's a quick decision tree you need to run through. Because investing in the wrong order can actually cost you more than not investing at all. Step 1. Does your employer offer a 401k match? If yes, contribute at least enough to get the full match before you do anything else. We covered this in video 1, but a quick reminder. An employer match is a 100% instant return on your money. Nothing in investing beats that. Nothing. Step 2. Do you have high-interest debt? Credit card debt above 15 or 20%. APR is a guaranteed negative return on your money. If you have $500 to invest but you're carrying a $500 credit card balance at 24% interest, paying off that card is the smarter financial move. Every dollar of high-interest debt you eliminate is a dollar earning a guaranteed 20+% return. The stock market doesn't offer that. Step 3. Do you have at least 1 month of expenses in a savings account? If not, build that first. Investing money you might need in an emergency means you could be forced to sell at a loss at the worst possible time. If you've cleared all 3 of those, got the 401k match, no high-interest debt, emergency fund started, you are ready to invest. Let's talk about where. The single best place for most Gen Z investors to put their first investment dollars is a Roth IRA. Let me explain exactly what that means and why it matters so much right now. A Roth IRA is a retirement account that you open yourself, not through your employer. You contribute money you've already paid taxes on. It grows completely tax-free inside the account. And when you withdraw it in retirement, you pay 0 taxes on any of it. Not on the growth. Not on the decades of compound interest. 0. Here is why this is especially powerful when you're young. Right now, at the beginning of your career, you're probably in one of the lowest tax brackets you'll ever be in. That means the money you put in today is being taxed at a low rate. Then it grows for 40 years. Then you pull it out completely tax-free, no matter what tax bracket you're in at 65. The IRS lets you contribute up to $7,500 a year to a Roth IRA in 2026. You don't have to hit that limit. $50 a month, $100 a month, whatever you can manage is fine. But there is an income limit to be aware of. If you earn above $153,000 as a single filer, the contribution limit starts to phase out. For most Gen Z starting their careers, you're well under that threshold and fully eligible. And here's something most people don't know about the Roth IRA. Because you already paid taxes on the money going in, you can withdraw your contributions, not the gains, just the original money you put in, at any time without penalty. It's not a completely locked box. That flexibility makes it significantly less scary for young investors who worry about needing the money someday. To open one, you go directly to a brokerage. Fidelity, Charles Schwab, or Vanguard are all excellent options with zero account minimums. You fill out the application online in about 10 minutes, connect your bank account, and transfer your first contribution. That's it. You're an investor. Once your Roth IRA is open, there's one question left. What do you actually put the money into? The answer for most beginners, and honestly for most experienced investors too, is a broad market index fund. Here's what that means. An index fund is a type of investment that owns a little piece of hundreds or thousands of companies at once. An S&P 500 index fund, for example, owns tiny shares of the 500 largest companies in the United States: Apple, Microsoft, Amazon, Google, and 496 others, all in one single investment. You're not betting on any one company. You're betting on the American economy as a whole continuing to grow over time. And historically, over any 20-year period in the S&P 500's history, that bet has paid off. The two biggest advantages of index funds are cost and simplicity. On cost, because the fund just tracks an index automatically rather than having a manager making active decisions, the fees are extraordinarily low. Fidelity offers index funds with a 0% expense ratio. That means the fund costs you literally nothing to hold. Compare that to actively managed funds that charge 1 or 2% annually and consistently underperform the index anyway. On simplicity, you don't need to research companies. You don't need to watch the market. You don't need to make any decisions. You put money in, it buys the index, and you leave it alone. The simplest starting portfolio in the world is this. Open a Roth IRA at Fidelity. Contribute whatever you can each month and buy FZROX, Fidelity's total U.S. stock market index fund with zero fees. That's it. One fund. Zero expense ratio. Instant diversification across thousands of companies. If you want even less to think about, buy a target date fund instead. Something like Fidelity Freedom Index 2065. You put money in, it automatically adjusts its risk level as you get closer to retirement, and you never have to rebalance or make another decision. Set it and forget it for 40 years. There is one behavior that destroys more investment returns than any bad fund selection, any market crash, or any fee structure. It's panic selling. The market will drop. It dropped 34% in early 2020. It dropped more than 50% during the 2008 financial crisis. Every single time it has dropped in history, it has eventually recovered and gone on to reach new highs. The investors who got hurt were the ones who saw their account down 20 or 30% and sold everything to stop the bleeding. They locked in their losses and missed the recovery. The investors who held, who did nothing, came out ahead. Research from Dalbar, a financial research firm, found that the average equity fund investor earned about 3 percentage points per year less than the index they were invested in. Not because of bad funds, but because of bad timing. Buying high, selling low, and jumping in and out of the market. The cure is simple and almost impossible to overstate. Automate your contributions, set up a recurring monthly transfer into your investment account, and do not check your balance more than once a quarter. The less you watch it, the better your outcome will almost certainly be. Investing is boring on purpose. Boring is how you win. You don't need a lot of money to start investing. You need a Roth IRA, a broad index fund, and a recurring automatic contribution, even if it's just $25 or $50 a month. The math is not on the side of waiting. Every year you delay is compounding against you instead of for you. Open your Roth IRA this week. Put in whatever you can. Buy a total market index fund. Set up an automatic monthly contribution. Then leave it alone and let time do the rest. I'll link the exact platforms I'd use in the description below. Next week, we're talking about high-yield savings accounts, the best ones available right now, paying 4 to 5%, and exactly how to move your emergency fund there so your cash is actually working for you while it sits. Subscribe so you don't miss it. See you next week.